Welcome to our 2011 update on federal estate tax planning hosted by Providence Health and Services Foundation in the San Fernando Valley. Our speaker is giving his second update on this topic, which we feel is very timely in view of recent federal tax law changes. He is Michael Overing, a practicing attorney in Pasadena, author of several newspaper articles and a former regular online contributor to Online Journalism Review. He has taught university and college courses since 1984 and is a member of the California Bar Association and the American Bar Association. He received his law degree from Loyola Law School and his MA degree from the University of Southern California. I might add that he's also a member of the Providence Health and Services Foundation Board of Directors. I welcome to the Providence podium Michael Overing.
Right. Thank you, Ron. It's my privilege to be here and to talk to you about some changes that have occurred in the estate tax area. We had a situation that has occurred over the course of many years. Shortly after the second George Bush was elected, we had tax reform, and by the summer of 2001, it was a significant change in the way that the estate tax was calculated and the size of the exemptions. And throughout the decade, or the first decade of the 21st century, we knew that there was going to be a repeal of the tax code, and we had been preparing for it coming up to 2010 with respect to estate taxes and the exemption from estate taxes. So in 2010, if you were to die, there would be no estate tax whatsoever. But one of the things that the tax code did was it returned January 1st, 2011 with a vengeance. And that vengeance was that there would be a $1 million exemption from estate taxes. If you live in a state like California where real estate is quite high, you know that having a $1 million home or having a $500,000 home and perhaps $500,000 in savings, that's not a very high threshold. So towards the end of 2010, Congress got together, and with President Obama, they got together and passed a new law. So I want to give you a little bit of history here, and then I'm going to talk about these changes that just swept in here in December. So the first slide I've got to show you is this one about the history. The government imposes an estate tax on your accumulated wealth at the time of your death. That means all of your wealth. It means your house, it means your savings, it means whatever retirement account you might have. It means including within that any life insurance on your person. So the exemption from estate taxes has gradually increased since 2001 during the George W. Bush administration, where from 2006 to 2008, the exemption from taxes was $2 million. In 2009, it crept up to $3.5 million. And in 2010, as I said a minute ago, there was an unlimited exemption. But that unlimited exemption was set to be repealed as of January 1, 2011. So on December 17, 2010, Obama and the Congress got together and they created a new exemption amount. And the new law increases the estate tax exemption to $5 million. It caps the estate tax rate at 35%, whereas under the old law it was up to 45%. So in other words, if they had not acted, a $1 million estate would not have been taxed. But a $1,001 estate, that $1 would have been taxed at 45%, or you would have paid 45 cents to the government as estate tax. The other thing that happened with the December 17th new law is that there is a concept in the law called portability. And portability allows a husband and a wife to each maintain their $5 million exemption, and whatever amount of the exemption is not used by the first spouse to die can be portable and given over to the surviving spouse. This is a significant change in the tax law, and it's one that I'm very hopeful won't ever change. What this does is it allows you, if you are the surviving spouse, to not only have your $5 million exemption, but also to keep your dying spouse's $5 million exemption, such that you could have a $10 million exemption upon your death. This new $5 million exemption means that every person has a $5 million exemption. It used to be that with a $3.5 million exemption, and your spouse would have a $3.5 million exemption, the only way to preserve your spouse's exemption upon that person's death was by having a special trust known as an AB trust. And I'm going to talk about that in a second. But one of the things that we have to alert you to is the fact that this exemption and the way that the tax code is presently written is that in 24 months this is going to expire. So we know that this is going to apply to decedents dying in 2011 and 2012. We also know that with the election of 2012, we can probably see that tax reform is going to be on the agenda again in a very short period of time. The other part of the law, as it got passed, is that this $5 million exemption now applies to the gift tax, and that's something that didn't occur under the old law. Under the old law, the gift tax exemption was $1 million, and that $1 million was maintained throughout the first decade of the 21st century, but also was set to come back and stay with us in 2011. But now, as a consequence of the new tax code, we're up to $5 million, which makes a significant difference for those of you who want to give gifts to someone other than your spouse. So this is the way that this works. A husband and wife could have a $6 million estate. At the first death, the surviving spouse would inherit everything. At the second death, the estate would be taxed on every dollar beyond the federal exemption. Now, since you have a spouse who previously died, and there's $5 million of exemption there, and now the surviving spouse has an additional $5 million, that means that we have a $10 million exemption, and there will not be any tax. And it also means that because the way that the law is structured, you do not have to have a specialized vehicle for preserving this exemption. In the old days, as I mentioned, you had to have an AB trust in order to make this happen. So now we have to ask the question in 2011, why would you ever do a trust? Well, the answer to that is 3 points. The first is to avoid probate. A trust is the primary way that we can make sure that there isn't going to be a needless and costly probate proceeding in order to clear title to your assets. The second reason that we would want to do a trust is to keep the administration of your assets and making sure that those assets go to the people that you want them to in a private document, and that's one of the biggest advantages to having a trust. The third thing that we can do in a trust is we can nominate a conservator. That way, in the event that you become incompetent as opposed to dying, you've got somebody who is already nominated who can take over and assist you with your finances, assist you with your living arrangements, and so on. So there are still good reasons to do a trust. In a basic estate plan that has an AB trust, at the first death, the estate is valued, and then it is divided between the assets belonging to the dying spouse and the assets that belong to the surviving spouse. So we fund the decedent's trust with the decedent's assets. In California, that means the decedent's separate property, and it means the decedent's share of the community property. That money goes into the decedent's trust. The income comes across back over to the surviving spouse, and the surviving spouse can go ahead and use that for his or her purposes for the balance of their lives. Then, at the end of the life of the surviving spouse, all of the money is then transferred to the beneficiaries. And as long as it stays below now the $5 million limit, there's not going to be a taxable event. So what is the purpose of an AB trust? The AB arrangement was designed to preserve the dying spouse's lifetime exemption from estate taxes. It allows the stacking of the two spouses' exemptions, thereby doubling the amount of inheritance that would pass to your children or other people without incurring an estate tax obligation. Now, because of this portability that has been written into the new tax law, the AB arrangement is not strictly necessary, but we still think that it's a good idea. So let me show you an example of this. If you have a couple who has an estate that's worth $6 million, at the time of the death of the first spouse to die, you would want to put 1/2, assuming that it's all community property, into the dying spouse's trust. Oops, I'm sorry. The dying spouse's trust then would be funded with $3 million. That would go into what we traditionally refer to as Trust B. It's sometimes called a decedent's trust. It's sometimes called a bypass trust. It's sometimes called an exemption trust. And again, as in the last slide, the income would go to the survivor. The assets would be excluded from estate taxes at the first death. and eventually the property would pass tax-free to the beneficiaries. The surviving spouse's trust would go into what we call the A trust. And the A trust would be completely allowed for the person who was surviving to spend as they saw fit and as they needed it. Then, at the death of the surviving spouse, that person's trust would be taxed based upon the estate tax existing at the time of that person's death. The new feature is this idea of portability. Portability allows the surviving spouse, upon filing the decedent's tax return, to transfer any unused portion of the decedent's exemption to the survivor. What this means is that if I've got separate property that's worth $3 million, I can put my $3 million and pay and file my tax return, or my estate can after my death, and the $2 million can be transferred to my surviving spouse. In which case, my surviving spouse would have not only her own $5 million exemption, but she would also have the benefit of the $2 million that I didn't use. Now, the limitation on this is that in the case of a subsequent marriage, say that she remarries sometime after my death, the portable amount is the lesser of $5 million or the unused exemption of the last spouse. Now, there may be some argument here that perhaps somebody would not get married as a consequence of the future taxability of what the estate would look like. But at present, we don't have any indication as to how this is going to play out, other than to note that this is the way the tax code is written. And finally, I note that with portability, an AB trust is no longer necessary in order to preserve the portability issue. You don't have to have a trust. You can have a will, you can have no will at all, and it can go by intestacy. And as long as you're married at the time of the death, then the additional amount that is not used from the exemption can be transferred to your surviving spouse. Why then would we want to maintain an AB trust arrangement? Well, there are two primary reasons that we'd like to identify other than having a trust in general to avoid probate. The first is that it allows the dying spouse to leave property to beneficiaries other than the surviving spouse. And this is one of those times where you would like the income to go to your surviving spouse, but maybe at the end of the surviving spouse's life, you would like to have the property go to your children, particularly if this is a second marriage. The second is that it preserves the arrangement in case of further tax law changes. And we would call this simply a hedge against what might occur in the future. And we certainly don't know how Congress is going to act and how the President is going to negotiate with Congress come 2012 in the 2012 election. So it would seem prudent to maintain an AB trust just on the off chance that the law does change again. So let me go back and give you an example of how this new portability feature works. So at the time of death, if we have a $10 million estate, at the time of the first death, then we have a dying spouse who has $3 million. And that's the $3 million of their separate property and their share of the community property. But there's a $5 million exemption, as I've explained. That leaves $2 million that is unused. That $2 million can now be transferred over to the surviving spouse. And the surviving spouse then would have, if they had a $7 million estate, they would have their own $5 million exemption. They'd get the $2 million transfer from the dying spouse, which would give them $7 million worth of exemption. Now what we have is a situation where all of the assets from both the dying spouse, the first to die, and the surviving spouse are going to pass to the heirs or the beneficiaries without incurring an estate tax. This is a tremendous benefit, especially for people in large estates, and it is something that we haven't had previously. So finally, I want to talk a little bit about the future, and there are three things that we need to emphasize. The first is, as I said before, this law is going to expire in 2 years. So we know that by the time we get to December of 2012, we are either going to have tax reform or we're going to have a situation existing like we did in 2010, where it comes back under the old law. Number two, we have the situation where the 2012 election may be very important, both because the baby boomer population is getting older and because if we do not have tax reform, these changes are going to go by the wayside. And so number three is that we have to watch for the legislation affecting the portability feature. This is new, and we don't know how this is going to be received. We don't know if it's going to be maintained. It is a nice feature of the tax code. We're very pleased to see this, and I think that it is going to benefit most people. Thank you for listening this evening.